Three core things that I'm looking for just because they've called every other recession. Number one, a peak in the profit cycle. So when the S&P 500 profits, I think it's slide 18, Josephine, it's when S&P 500 profits break below their 12-month trailing average. Okay, so that's point number one. You're coming off not only, that just happened in the second quarter of this year, it's currently the fourth quarter, that just happened, but you're also coming off the all-time bubble high in that chart. That's a crazy chart. Don't only write that down, like stick it in your notebook, cut it out, get your kids to make some paper airplanes with the rest of the paper. These are critical charts. Look at what happens to that when it starts going off its rolling average high. It goes down really fast from the all-time high. Do not put your kids and their entire, I guess, fortune, your fortune, on that roller coaster at the very top with no seatbelt. Not good. Second one, consumer confidence. Consumer confidence, I think it's slide 14, Josephine. Consumer confidence. So when consumer confidence breaks below, it breaks off its cycle high. And a lot of people said throughout the year, well, what if what? No. Do you think that the stock market doing what it did at the end of last week was going to get people all fired up for Christmas? What if they're long a junk bond fund or a commodity or foreign currency for that matter? Or a private equity fund that hasn't marked its book to market? I mean, people aren't confident right now. No. What happens on this one, again, it's elevator up, windows on the way out. You can see it happens, and the red line is coming. And then the final one is jobless claims. Actually, if you go, we can use different ones, but I mean, go to jobless claims, slide 25, I think, Josephine. So that one, peak M&A equals layoffs, and peak M&A equals layoffs. Yeah, well, so what happens now at this stage of the growth slowing is that people buy each other and they fire the people at the other company. Now again here, this is the rolling 6-month average of jobless claims. Unless it's different this time, this data series always peaks at 600,000 and always bottoms at 300,000, the rolling average. Currently, you're at 12 months. In 6 months from now, you're going to be exactly where you've been right before the prior 3 recessions. Again, you add 6 to 12 and you're going to get 18. If you want to add 8 months, that's fine, because in the second quarter is where we're telling you that is the highest risk of a recession in the U.S., at least being printed on a quarterly basis. Now again, that's important. If you can stay ahead of that, you're going to continue to make a lot of money. The next move for this line is not down, it's up. All the energy companies rolling off their hedges, anything that's tied to the industrial or cyclical side of the economy, anything that's tied to bubbles, junk bonds, or venture capital. There's so many different places that you're going to see M&A. Do you think DuPont's going to double their hiring after this? No, they're going to fire people. I mean, this is very obvious. So those are the 3 things. Hopefully you have them all written down, cut them, put them in a, get your kids a notebook for the holiday season. If you want, I can help you build a custom one. We can maybe have a paper mache session over here. We're going to do like some coloring and
arts and crafts.
Arts and crafts, because I think it's important for people to know what they're doing.